Greetings, market rebels. Welcome to this week's macro measure. I'm Wayne. It's about 10 to 3 p.m. here on Friday, January 5th. And my apologies in advance. I've got to record this due to some weekend obligations that I need to meet, and then have the cocktail hour, of course, at 4 p.m. today. And so I've got to get this taken care of while I can. So I'm working on it, and let's get rolling. Again, this is macro measure combined with sector situation. I'll hit the trusty disclaimers of ours there. There's the trusty disclaimer, and then here's the trusty intellectual property rights notice. And then we have the updated stream of consciousness, talking points, what have you. I'll leave this up there just for a few more seconds. Hopefully everyone can screenshot this if you want to follow along with the discussion. I'll try to highlight things. It's a little bit more in-depth this week than it typically has been. There's just a lot going on. It's the start of a year. There's a lot of uncertainty out there. It's been a rough start to the year for the market, all that kind of stuff. So we're going to do the best we can under the circumstances. That's what we try to do each and every week anyway. So we will get started. I will now sort of shift things around. So just bear with me while I stop the share, shut down the talking points here. And really on the talking points, what I've really got there are things that are, let's see if I can get back over to screen 3 now. I'll start here. But what I've really got on the talking points is updates to former talking points are really highlighted this week in orange as best I could to try to just convey, some things. But I'll go through a review. And what I wanted to really do is just start out and say that I'm going to talk a lot about the levels that I think we could pull back to if we don't hold this week's lows, and that's becoming really like a possibility, a much more strong possibility, because I just saw some weekly lows being taken out on the charts off screen. But anyway, I'm bringing this up because the breadth had been really good, and we noted how well there was so much sector participation. But again, we noted duality. In other words, it rarely gets much better than that. And that was the reason for caution. And you can see that there's the spies above on this daily chart. And you can see that a lot of these breadth measures have now really sort of started to back off a little bit or have rolled over. The McClellan oscillator definitely rolled over beneath the zero line. So this has been, I would say, a pretty rough stretch. The last 5 sessions of this in the market really have been quite rough. We're getting a little bit of a rollover beneath what I would call support in the McClellan summation index. I can't get that line to work perfectly for some reason down there. It just fights with me. But you get the idea. So the market really has taken a beating. I could probably move over let's see, we want the sectors. I could probably pull these up because we'll come back to these. I've got some fibs to share on some of the really key sectors. But what I wanted to note just at the start here is really how a lot of these sectors have pulled back dramatically, right? In terms of RSI readings, leader XLK, way back into a 40 reading. And I would note that as well, that during a really strong bull market, you don't get below 40 all that frequently. So some things that are getting down there, like the consumer discretionary, you would think if this new bull market argument that was really advanced by the usual suspects at the end of the year, I'd say with some real gusto, very vociferously, right? This pullback should end fairly soon, if that's to be the case. That's because that's normally the case. There's never really a lock, but what I'm getting at is you don't really get much more deeply oversold if you're really in a bull market where they can't wait to just come back and add more at lower prices, on sale prices. And so some of those things should happen. But just note, right, just briefly here at the top of the video, that a lot of these sectors are now in the 40s and 50s. Some have remained incredibly resilient, like XLV. That's been really resilient. XLF has been very resilient as well. And that's a good sign, I think, in XLF in a way. I think it's, to me, like it's a little bit out of step and misleading, but they're loving that right now. We had a lot of city paper. We had it as an idea when I kept passing along updates because we suggested folks keep an eye on city, and you just look at what it's done. this week. So it was looking pretty good last time I looked, but this is a little concerning in terms of, right, things are maybe getting a little more defensive. But we'll talk about all these things. So I'm going to get started really just with I'll pull up for now. We'll just pull up a basic SPYs chart. We're right there on there. And this is what I mean in terms of levels that I'll be talking about. I think the next big issue we have to tackle is going to be where does this thing potentially stop at now that they've broken below the 20? They broke below the support lines that we had drawn. And we came in thinking really a pullback made the most sense, but it also made the most sense a couple of weeks before that, and the week before that. And I mean, it's been the way that the market was. And I think the market, and to a degree, got exposed for being essentially rigged into year's end a little bit here. And that whole hangover we've been talking about, will they have a hangover, bulls that is, after what they did? And that, they didn't waste any time. I mean, the hangover started on last Friday before New Year's Eve, kicked into full swing, at least in the U.S. So that started then, and it's just been a really rough start to the week that's only really gotten worse. So I think what you have to look at is, well, where are some flat lines, where are some SMAs, and where are some fibs for starters? And the next one really is at about 461. So you're looking at another 1.5%. And remember, we've been saying we thought there would be between about a 3 to 5% pullback, just ballparking it, because that's what I do. I don't think I don't think my experience has been that it's just not worth trying to pinpoint these things. I do throw out exact numbers, but I don't really expect it to go exactly to that number, right? I'm talking about getting in that ballpark, that vicinity. And so I think the former high right near here, right, that's the former high we're working against. And that's at about 459. This pullback area is about 461. And that there's no SMAs anywhere nearby. So I would say really right between 460 461 becomes a very obvious area, right? That you would expect that if they're going to let this thing drop a little bit more, it does drop a little bit more. Where would it find some confluence, right, of a few different factors? And it's going to be right near the former high, in my opinion, and right near this fib. So just think about that for now. We did talk about these last week. We talked about them in the IWM. I remember putting a line in, and I think I made that one particular line pink, because I really wanted to keep an eye on that one, because I think this whole story of how everything's going to come roaring back, and rates are not only done going up, but they're on their way down sooner than later, and they're on their way down to a large extent, 6 rate decreases expected for the year, that kind of talk. Then this would really be, since this lags so much, and since these are so interest rate sensitive, these smaller companies, this would be the one that we would say, well, look, IWM's killing it. So, this does start to shape up as being not just NASDAQ led or blue chip led or Mag 7 led. It's actually really kind of broadening out even into these smaller, more vulnerable companies. And so that probably does mean people really do think that rates are going to get whooped this year, and that rates are going to get whooped quickly, start to get whooped quickly because of the effects of lag. But you could see that the breakout attempt, which we said to be on guard for, and I'm not saying that as if we're patting our backs. I'm saying that as I will say that every time, because I always assume that someone that's newer, that hasn't seen their fair share of false breakouts, doesn't know that you really need to be on guard for them virtually every time. And so you got through the upper end of the channel that IWM's been operating in. We had the 193.64 line. That was really a gap closure line we were talking about there. And also, right, you probably could go back and say there was probably a flat line also near that level, not really dead on, but it did hold on Wednesday. It did hold on Thursday, but it's with just 1 hour remaining, they are at risk of cracking that. And so the next level down would be about 188.75. But this is already put together a nice pullback. If you think about going from 205 to 192, excuse me, that's about 13 points. and that's also about 5%, roughly speaking. So the IWM did that. It did close this gap we were talking about, and now, right, where we have to kind of rely on, well, what's going to stop them now, right? Well, could be there's a little bit of flatline-ish history there. It looks like if we look back to the left, but the other thing is, remember, these guys are great at exceeding, right, clear levels where a lot of people would expect support, including us, and then reversing it hard. So that's why, again, this game is so tricky, because there's a good case to be made for if they hold this here. You could walk in on Monday, they'll have some fantastic story all over the news, and they'll try to create, right, yet another squeeze higher. But if they do, I'm glad we stumbled across that. This is really, I think, the key thing to look for next week. If they manage to do that, then you have to be on guard for, do we put in a lower low? I mean, I'm sorry, a lower high. If we put in a lower high and then we already have cracked the intermediate term support like we have, and if you care to, just use the 20 SMA there in light blue for the trend support, then, right, that's a problem. You crack the trend, you tried to rally, you didn't get anywhere near the highest high, and then you go back into failure mode fairly quickly. That's a problem that probably leads you down to larger degrees of retracement of the move off the lows in late Oct into really nearly the very end of the year. And probably the 50, if that were to happen, I would say the 50-day and the confluence of all these other SMAs along with the 50% retracement then becomes my odds on, right? Where lower high start breaking down, the retest doesn't hold. I don't think it'll, never know, but I don't think it'll just hold there at 188. I think it'll probably have a whole nother leg of ugliness if it has a weak lower high as a result. So that's the kind of stuff I'm talking about when I mean, like, I'll give out levels and talk about them. I've got levels pretty much ready on the other major market ETFs, because I know a lot of you like to trade those, and that's why we chart those instead of charting the indices themselves. So just if people were wondering. But what I may do now, since we kind of dove into that, is just back up a little bit and let's see, right? I'm going to just make sure I make mentions of things. Probably should have said this already. Set playback speed to 2x. Did say last week, right, kind of looking forward, thought this would be a lot like 22 and 23, and it's starting out that way. It's already acting as if this year is like that, because, right, this is really that hangover that we talked about. It happened quick, and there were no prisoners taken. They didn't really give a lot of patient bulls a chance to sell at the levels they were able to sell at last Thursday, and so the pressure's been on really ever since. I did the next very note and theme of the week is the next line down is at risk of lower highs, which could suggest more downside. Watch for signs of more or exhaustion, right? So we have to see if this move exhausts itself and we start to see a turnaround, right? But if they really can't turn it around, there's more pressure without an attempt to really rally. If there's more pressure, the next level then just becomes this 188.75 for IWM, which we're on right now. But we did have this as I think, UA Essential name this week that went out on Tuesday. So it went out, I think, prior to Tuesday's action, because that's the first trading day of this week, and it's been a good one. And also, I think we had CRM as the I want to say Rebel Pit Pro idea as the main focus idea. We always put out multiple ideas just in case we catch a news event that ruins our main name or something else. But we had this one, I think, breaking down or breaking out, and it broke down. It's also delivered a good move. So it's been a good week if you were willing, I think overall, if you were willing to trade that bear side. But the thing about this market, and I'll just bring the spiders up for that, is that's what we usually talk about. The thing about this market is that the Santa Claus rally really fizzled and late last week, and it started out, this week, supposed to carry on, I think, into this early part of the year, and it's been poor. And the start of January also has been poor. And so this doesn't really portend well for this year's fortunes. It's certainly not ideal. So if you were looking for more banner performance, You're not getting that, and that can set the tone for the year, believe it or not. A lot of people follow that stuff. So just like anything else, it could become a little bit more self-fulfilling. It's just the way the probabilities have played out over time, right? The performance has played out over time. So anyway, that's why this swoon, which seems relatively innocuous, could be a little bit more concerning ultimately than it would first appear. The other things we would kind of hit on is that we noted that last week, just as review, we said, right, many of the sectors were due. We also said that the ETF, major market ETFs look vulnerable, so did the Mag 7. But you also always have to be on guard for that holiday action. In other words, you don't want to overread something. We did say that those trades were crowded. We did say that they had negative divergence in some of those we just mentioned. So a lot of that did seem to matter, right? It was the real stuff. It turned out that it wasn't a false weakness that we saw due to the holiday. So you just never know. Unfortunately, you just never know. Anyway, most likely scenario, we went with pullback makes most sense, but New Year's buying can be a thing, as I just mentioned. There was no New Year buying, right? It was the most likely scenario did play out, for a change where you just got the pullback that really probably was overdue and you should have gotten a little bit more, but along the way towards the year's end, but they just don't do that often. That's why December ends the way that it typically does, and then this can happen. So only because we've been through it many times, or we're ready to factor that in as a possibility. We also noted, right, that you got to. This is what I mean by the false breakout. So I left this in, and I said, like, I really like the Tesla chart a couple weeks ago, and it really, to me, looked really like it was getting ready to do something big and leave this downtrend, because the intermediate term trend has really been improving. But this is really what happens, right, when you break out through that orange resistance line that I've got there. I'll highlight it, and it should be blue now. You break through there and you go. But remember, they were doing this while the market itself was really exhausting itself to the bull side. And so you could see what happens, right, when this is exactly why you have to be disciplined in your trading when you trade breakouts or breakdowns, because it's not that you might just be wrong, but if you don't react and say, look, this is not working, this is turning out to be an ugly, bearish, engulfing reversal candle, I got to get out of this thing, right? Or I've got to neutralize my risk in some clever way. Well, if you don't do that, this kind of action, the false breakouts or false breakdowns, it becomes take no prisoners. Look at this ugly day, way outside of the Bollinger Bands at that point. Probably right. Your RSI was down at 25 that day on the close. Ugly. They make it look ugly. They barely, remember, I mention this all the time. They barely exceed that low and they reverse it. And so you're having a bad day, but if you don't react, you have another bad day. And before you know it, you're having a really horrendous week, right? So that's why you've got to be disciplined in your trading, because not only could you be wrong, but they could make you pay very much so quickly if you're getting that kind of strong reversal action. And remember, it happens frequently, right? Especially when the markets are overbought or oversold, and a stock's trying to break out late, or if you just don't have a very strong trend, right? If you don't have a strong underlying trend, there can be a lot of false breakouts. Well, I should say more false breakouts. So anyway, a good chart, looked good, but again, that's what you're on guard for, and that's why you always hear the people that are in our services where I chime in. I'm always talking about that quick trim, and that's because if you bought on the breakout, whatever you held, you bought the pullback once it started going back up, whatever you did, the fact that you took, I always use a 10 lot base. If you had 10 calls, they were doing pretty well, and you just sold two, after this thing kind of got up towards where you'd say there's a flat line resistance up there at that point, which is at 263.86, something like that, just making an argument, I'm going to sell two. Right. What that lets you do is if it comes all the way back to your entry level, and even if you have a little theta that worked against you, you can probably still eke out a small win and just call it a day, and then just reset without any real frustration, money lost, psychological damage where you're like, I had a winner and now I turned it into a loser, which is probably the worst outcome of them all. I'd rather just be straight up wrong than actually be able to turn what could have been a decent little winner into a loser, right? That's the more frustrating thing. So just a little tip that I would add for folks that are newer. What else? So we said like keep an eye on TNX and DXY, and we talked about those being in um, channels and getting nearing resistance, and so that they were overdone and they were due for a possible bounce, and we got that. And you could see right there's the channel that I made a little more clear today for the video, but you get the idea right that the bears have been in control, but suddenly right? I mean, bears and well, I think you know what I mean. Bears have been in control of the stock market. Part of the reason why the market's been rallying is because yields have been dropping. But now you can see that, right, the yields are rising. So let's call it TNX bulls and bears. So TNX bears were in control and TNX bulls tried to step in and they're through the channel. So you've got to be on guard for more. The same thing's true of the dollar. Remember, these are inverse. They have been inversely related to stock prices. And so, excuse me. So here you have it, right? This is something I've tried to point out in Rebel Pit with a couple of little picks this week, just to be ready for this because this could be a problem too. So it could still be a problem. It's not really a big problem yet, but if this does start to break out and go, right, you all know what can happen. So that. I'm not going to belabor that. They did actually, that kind of bounce we were sensing did appear. Remember, prior to this sell-off, the CTAs were fully loaded. The odd lotters, in other words, the public was extremely long and poured a ton in. That we reached extreme greed and CNN's faulty measure. We did it through the AAII readings. We did it through our own sentiment readings and other things. For example, if you go back and look at the percentage of stocks, I tried to make this clear to save us time this week. I like to go through these individually, but I bunched them up. And these are all different percent of stocks above the 50 or the 100 or the 200 respectively. And you can see that those all really got towards an extreme, right? They don't really get that much higher for that much longer than they did there. And that means, right, that's kind of fit. That's why I was saying well, I shouldn't say that's why, but one reason I've been saying that it rarely gets much better because you had these awesome breadth. You not only did the sectors really do super well, right? You had so many sectors participating, formerly like plagued or troubled sectors that began to participate, but you also had just tremendous breadth. I think overall, I think the big missing piece was XLE, and it still is. The best thing I keep saying the best thing we could say about it is it hasn't gone down, and that's good. But it just keeps. We see some paper. It keeps threatening to try to go, and it just can't do it yet. And we'll see. But here's the SPY, right? And so you could see that if we kind of put our cursor on the year's end, you could see that things were wonderful from a breadth perspective, right? And again, when you see something that's really at the higher end of the scale that you've got to work with, you kind of know like, well, it just doesn't often get very much better. So you've got to be, in other words, conditions, just like we said a few months ago, conditions back then were rife with the market was rife with conditions that precede relief rallies at the least. The market was currently rife with conditions that precede sell-offs. Right, that's the other way we could put it. Yeah, conditions that precede pullbacks is what I wrote here in the notes. We did say that there were some fissures appearing. We did say that the market looked vulnerable. It was, right. It was vulnerable. The hangover happened. We already talked about that. We already talked that this could portend more than just a bad start. It could actually affect the year in some people's minds. It's not something that's going to really affect me, honestly, but I don't disagree with their analogs. I just feel like, right, the news could unfold in different ways. That could change things. News has a tendency to do that, and then price will change, and then price changes people's minds when price changes. So I think the big problem still remains that some people are calling for a rate cut timing to be sooner and to a larger degree. And that after this week's news, that seems to be called into question. I think that's what's kept these markets pressured. Now, the last 5 sessions have really cooled things off. We did note that. So there's potential now, right, for not necessarily a relief rally that we're looking for one, but I think, right, if you're in a bull market environment, the way that a lot of people really want to push that we are now, a lot of these Twitter, formerly Twitter people or X people, they're pushing that hard, and they may be right, and the market's trend is still up and all that. So all that's intact, but again, I wouldn't say that we're out of the woods personally. I still have great reservations. I think that my thing was I am taking their rate cut story seriously, but I do think these guys get ahead of themselves. And I think I may have said it last week. They got ahead of themselves again. So on the second pages of notes, second page of notes, I should say, what do I really have to? So I'm just going to jump past the bull side, go to the bear side. The drill downs into jobs and consumer data are very concerning. I've read some stuff this week. I'm just going to pass that along. The stuff I've come across, it's not as wonderful as they're making it out to be, and that's not news, but it's a lot worse than the normal glossing over. So things are just not that great yet, and I just hope to be wrong. That my concerns are just not well founded. That the typical fourth-year performance in the presidential election cycle will be there. We'll all be happy at the end of the year because everything did well. The economy hung in there, all that kind of stuff. But remember, the administration really doesn't want to see the economy falter right when there's theoretically another election, coming up in whatever it is, about 11 months. So this whole situation where people jammed the way they did and to the degree that they did, and a lot of the usual suspects plowed just a fortune into here and chased this. That does set up trap potential, right? When so many people are in. So the CTAs are in, as we said. A lot of these players are in. So you've got to be careful because there could be, there still could be a rug pull. There could be a trap. The jobs data, some of these, some things I've seen that are on kind of lesser publicized stuff, that temporary job ads, right, or advertisements where they're looking for temps, that's really rolling over, and that's been a pretty good indicator about in front of prior recessions. A lot of the jobs too that people are celebrating are second jobs because people need them, unfortunately, or they're lower paying jobs, which are not needle movers, right? Things like hospitality, which a lot of folks pick up really as a second job, or a lot of young people that are in some sort of an educational program or what have you will pick up. So nothing against those jobs, just the idea that this is really great, well paying, doesn't seem to be supported by a lot of the stuff I came across. The other thing is, right, that the story on inflation, I'll jump down to shipping rates. They're spiking. So that could have an effect on prices and maybe won't help things out in terms of bringing down some of the rates of inflation that are bogus, but that's what everybody winks on, wink, wink, and goes along with. So even those numbers might be held up by some of these spikes in shipping. Remember, just to reiterate, the easing is likely to happen, I think. I just don't think it's going to start immediately and drop as much as they think, but I do think there probably will be some before the election. But remember, when they do start to ease, that's not normally a good thing a year later. Just a reminder on that. I'm still not buying what the perma bulls are selling. I hope to be wrong. That's why I've got it written that way. I just don't buy this. I think you do have to still be ready to play defense. Clearly, this week's was a great reminder that if you don't know how to play defense when you're long, you need to learn that. Or if you want to become a player on the bear side, you have to learn that if you don't know, because there could be a lot of this year and future years where we're dealing with markets like we did in 22 and 23, which I think we will. And having premium collection, for example, strategies that do well when stocks are not really strongly trending, that can help you out, right, to kind of offset theta and other things that you're looking to catch rides in that are not yet firing for you, right? So it's all goes together. I think the most likely scenario in the upcoming week is that we're just not out of the woods yet. But I do think you have to rely on your levels. I think you've got to just sit there and say, and this kind of goes back to trade that, work with that market in front of you, the MIFOY that I put in last week that's in this week, because just like we talked about in SPY and IWM, and I'll talk about more levels here, for on the other ones as well in some of the sectors. But that's what I'm getting at. I think you just have to just trade what's here. We don't know if this will keep going yet and just drop to our next fib combined with a flat line. We don't know if they're going to try to reverse this on Monday. And if it goes right back towards the high, goes right through the high, puts a lower high in, and then starts rolling over again, so you just kind of work with what's there, because the trend is at risk of being cracked. And if it is, as I said, that portends like a possible visit to the confluence area of, I'd say, 451 to 453 in SPY, right? So that's what I would look for next if this thing really doesn't find a bid and find a way to stay buoyed. The other factors are, let's see, covered all that. Yeah, beware possible lower highs. That should have been orange. Don't know why I didn't do that. And I said, just be ready if we do see rollovers and retests. Try to look for what we are looking at here. Try to look for areas where you see good confluence between flat lines, SMAs, fibs, things like that. Even where patterns project to, or parts of patterns can help, and so on. But mainly the things I mentioned. But anyway, that's what I would do. And I would just stick and move with this, because this year already started out, I think most people are way more comfortable on the bull side. It started out rough. So, you're going to be tested, I think, this year again. The last few years have been great trading years if you're willing to trade both sides. But if you're not, they've been very difficult at times if you're really just trading on the bull side. So I mentioned it last week, just so everyone knows, it does create a wall of worry, but there's a lot of high profile Elliott wave people that are saying that we have reached a major wave 5 of 5, a terminal wave on really kind of big picture, long-term stuff. And they see a massive bear on the way. And excuse me, I'm not throwing that out for fear. I think you should just respect the risk factor. They're not always right. No one is. They do have some really good points that they're associating with what they think will happen. So I tend to agree on that side of it. I just find that Elliott wave, like, you can get two experts and they might not even agree on the wave count and where you are in the grand scheme. It's still an eye of the beholder thing. And that's what makes it hard. And it's just a little unwieldy. Like, you really have to do your work beforehand. It's very hard to for me anyway, to flip on the fly and say, oh yeah, size this up very quickly and then make my determinations on position management. So anyway, just wanted to mention that. Remember, keep an eye on the RSIs. If they really do manage to keep a lot of stocks that are pulling back above 40 on the RSI, that's good. And you don't want to see the breadth that we looked at deteriorate too much more. I mean, that McClellan oscillator is a little concerning that they battered that as much as they have. But if you notice, like, the percentage of stocks above the SMAs is still really hanging in there, right? So, and other things we're looking at, they're still hanging in there. McClellan's summation is at risk of cracking the trend, but remember, it's a slower mover. It might ultimately just come back a little more and put a much higher low in and try to really continue to rise. But this cracking here, I think, is concerning. Overall, I think these are hanging in there, the percentage stocks above the various moving averages, though. So you really want to see this thing get arrested quickly. If you're a bull, I think if you're a bull, you'd be thrilled, because things are now far away from overbought in a lot of key areas. And there was a sort of a really vicious sort of start to the year pullback, and it probably scared a lot of people. And so that can be really good. We did say that a lot of things were due for a pullback. They pulled back. That was last week. On a side note, still not convinced that we're out of the woods. The bond market is taking the rate cut seriously, but I'm not convinced that the bond market really is out of the woods, or I should say yields are out of the woods. In other words, that they'll go down. I still think that's possible that they do not go down nearly as quickly to the degree that the perma bulls think they will. I just want to note that. My recommendation is to remain focused, avoid complacency, same as last week. Work with the market in front of you with discipline, but really use the charts. Use the charts and the price action to the best of your ability, and just keep an eye on things. And right, that we just do it this way from level to level, right? Because you just don't know if they're going to put a bounce together. You just don't know. So that's why when you get to a level, it's really good to make an adjustment, right? If you've had a good run, I was talking about this in Rebel Pit, so to speak, because it's all chat, not really talking. But I don't talk that often in the webinars because I just have my hands full with a lot of things. But this is the level we put out. We talked about this earlier in IWM, and this level, oops, I didn't even realize it did that. There you go. We'll get back to that. But this level, it got to it, and like I said, it respected it for 2 days, right? And now it's fallen beneath it and it's trying to work its way back towards it, right, off the lows. So this is a level that's being respected. And that's all I'm really getting at, right? That when someone said, I feel like, it was a mistake to have rolled, and I think they did that right here. I thought it was a great move, because if they had been riding and they overrolled to like 35 delta puts, right? I'd rather be in 35 delta puts if they're going to try to bounce this thing. And if I give it a little leeway, I might say, well, if they close it above the 20, I'm going to be done, right? I'll give up on my 35 delta puts. But they weren't able to do that, right? And so now, right, now that you rolled, you're still in. You weren't sweating as much as you would have been on Thursday when they started moving this thing back up against you. And let's say you stayed in 90 delta puts, and you really would be giving much more back. That's the whole, when you get to support, I think it's smart to make an adjustment or trim a roll, a combi right away, unless the market's really in a unique phase or mode. And I say that because usually support will hold the first time down, in my opinion, in my expectations, my experience. So, right, why have to live through something and experience more sort of adverse movement or frustration against you because you're higher delta? We take that money. If they do pull off the complete reversal, then you gave back a lot less on your roll, right? If they just keep going, you're still in the ball game. And then you can, even if you want to, you start to see the failure really kicking in. You can roll from 35 delta to 65 delta, and just re-intensify your position. Anyway, I don't want to go too far into all these little tips and tricks, but these are just things that I found that helped me. So that's why I mentioned them. IWM, eyes are still on it. XLE, commodities, gold, silver, the TNX, DXY, and Mag 7. So we talked about all this, so I'm not going to belabor those. But what I will do is go over to the Qs. We haven't talked about levels in the Qs, and I've got some fibs there. So I say I've got some fibs there, Thinkorswim. There they are. So the fibs we're right on the 23.6. The next one down, it just makes it easy, right? Because 38.2 is really, right, that's what we're expecting, really, more so. And if there's more downside, that's the next level we'd be expecting. Everyone will be expecting. And there's the 50-day rising to right about the same vicinity, right? So that's going to be right about 386, 387 in that area. That's another about another 2%. And this is only down around 3-something%, I think. So, right, 413 all the way to 395. So that's 18. So no, I guess it's really more of a 4% at this point with today's weakness. I was thinking yesterday. So yeah, 4% now. So another 2%, little more than I expected, honestly, but that's just the way the technicals are shaping up if it does plunge. And remember, I would bid in front of it, and you can sort of see in here, there's a little bit of a flat line right about where I am. So 388-ish. I think if we go back in time, we'd probably see more price action that respected that level. So I would say 388-ish on that one. As far as getting back up, I think keep your eye on the 20-day, and by the time it would get there, more than likely, the 10 and 15 would all be waiting for it. So that's going to put you at about 403-ish, right? So if it's able to break back above there, you definitely start feeling better about it. But if it gets hemmed in there where you'd expect it to, in terms of there's SMAs waiting for it, there could even be a little bit of flatline stuff near that 420. Yeah, I mean near the 20 at 403. So I think basically right around 403 is your number. And if you can't get through there, then that's what I mean by lower high. Resistance is still working. And then you could be headed back for the retest of this week's low, which is today's low. But again, that's getting ahead. But I just that's all I really do though personally is just walk through these possibilities in my head. And when they do materialize, a lot usually, one of the things you're thinking, you're going to be right about one of the three or four things you're thinking. It's going to come close to that, and you're not surprised. And then you sort of have already mentally prepared yourself, even without thinking about it, for what you're going to do at that point, what you're then going to be watching for. Let's see. The 20-day cracking would be a problem in diamonds. They've held up the best of them all. Some of those big names just haven't given much back. Probably the financials being strong and maybe energy hanging in there could be contributing to this. I'm really not sure. I'd have to go look at it more deeply, but it's right on, or right near, I should say, a flat line. I think there's a little flat line that developed right near here. So that's holding at the 20 is at 372. So that's going to be right below where we are by, less than 0.5%, it seems like. So that's a big deal there. That gets lost, then you would probably start going into bigger worry mode, and you're probably looking at 365. So that would invite more downside. Where does it have to get back up to? Probably want to see it get back above today's high at this point, at least, right? Because that would put you above all your SMAs. It would at least show one high being eclipsed, ideally on a closing basis. But those are the two levels, and from that point on, I would use these, right? The 50 38.2 confluence is a no-brainer, right? And remember, cheat in front of that if you're bidding. Don't bid right at that 50 or right at that fib. Just go a little bit in front of that, because you have a lot of company there, and if they are in the mood for a bounce, you're going to regret it. Diamonds covered. We covered all those. Now let's take a look at SMH, because this kind of moving into the sectors. This has been a real leader, excuse me, and was due, and we talked about how a lot of these sectors were due, and I think 161 is really jumps out at you, because you've got the 50 rising there, you've got that fib right near there. I've got a white line there that's flat, which means I'm thinking there's price action from the past that was big there. And there probably is to a degree. So there's a little bit of a flat line activity, or I should say behavior, that's near there, I think, as well. So you're right in that zone. That's the next one. This doesn't look good, right? Because you could say the last couple of sessions were a pause. And it's a little concerning, right, that you were not, given how wonderful this whole year is supposed to be, as per just a week ago, according to so many people, right? You could see that this little rally attempt is not really faring well to this point. So you have to be a little concerned that you're not even back up here, where they're even threatening to maybe pop up back to the SMAs at the moment. So there's still some heaviness there. Maybe, right, this just got over-owned by every Tom, Dick, and Harry that are out there. And now they're, of course, late comers, right? Johnny come latelys that show up late, overload themselves, buy into the hype too late. Remember how we were talking about divergences, double top? There's a great example of that one. That was last week. We were talking about those types of things. So as of right now, I mean, to me, like, if this closes poorly, like it's doing so far, you never know from weekend news, but this doesn't look very good, right? I'd almost say that the odds probably favor dropping another few percent if it closes here or worse, I would think. So just an idea, but you kind of have your ideas. You got to get back above the 20 to the very least to start feeling better about it. And if it's dropping, where to look next. And that's going to be at that 50, near that 38.2% fib. So that's the big one on that. I do think, let me double check on my sectors. So I've got those, and I know I've got fibs on a lot of these, so just bear with, because I don't want to overlook them. I know that we're combining the videos this week, so I may have one in XLE, but I'm not really this sector itself is, again, every week I say it, it's its own thing. This is not one I added a fib on. Disappointing while we're here, we'll just note, I mean, disappointing. Right at the 50 on the RSI, 50 reading. So, this could pretty much do anything. It's not going down. It is hanging in there. We have seen ostensibly bullish paper. But, having said that, with one little bit of bout of weakness, it could be below the 20, which is light blue there. And then you're down, excuse me, below all SMAs again, and maybe plumbing on your way to plumbing the lower regions of this consolidation that is this channel has been tracing out. But that's sort of another disappointing one. Again, you would think if things are so wonderful and we're about to pick up the way they say, that energy would start to do a little better. But again, it does have its own characteristics, excuse me, that you have to be on guard for. Here's one that should show up with a fib. There it is. And the fib is, again, it seems like the 38.2, the 50-day are all, it's showing up a lot of places. So that could be the big deal. So anywhere between, let's say, 180 and 182, and you're not far away. I mean, if I'm a bull, I finished poorly today. I open lower on Monday. And if I have intentions of buying, I draw more sellers in, make it look like it's cracking below the 50, below that retracement, and we have an ugly start to the week, and then they really do their thing. I mean, that would be how, if I put my market maker face or hat back on, that's how I would want to engineer things, ideally. XLC. Should also, I believe, have a fib appear on it. And it does. And so you can see this is hung in there better. It didn't have the incredible run that XLK did. It had a good run, but not quite as good. And we're looking at about 71 on the pullback. I think today's high or getting back above the 10-day at 72.46. That's what you'd want to see. And remember, these are two leadership sectors that we just covered. You'd want to see them get back on the horse. And if they don't get back on the horse, that's really not a great thing. You can't really, like I said earlier, you can't really complain about XLF other than the fact that it's got negative divergence cropping in and it hasn't gotten pulled back down. So just keep that in mind. You can see that the readings are worsening on some simple classic indicators, and you can see that, the tops are about the same. So every time it just continues to weaken, but it's held. I actually have a bullish idea in there because there's been bullish paper. Certainly that could be hedging. You can never really say 100% that it isn't, but I really felt like this was showing some remarkable strength. And if the gang did manage to really hold and then reverse the market to kind of have a happy ending on Friday, like they often do, that this would pop a little bit. Well, it hasn't happened yet, but I got to say that I want to give XLF a pat on the back for hanging in there. I don't even know if any of those ideas triggered, by the way. I'm just saying that I just noticed that it had some good characteristics. We did have XHB and XLRE. And I just want to mention this because I talked about this as a possibility. We put an idea in on this one as a bear. I don't like fighting against strong trends. I especially don't like fighting against strong trends that make no sense to me. So because I could get lured into that and get too aggressive. But this made no sense to me. But I respect it until it starts cracking something. Obviously, it did start to crack. You can see that 15-day there in red, the 10-day in white. Put the idea in, and at least that's backed up a little bit. It hasn't, not a major windfall. But to me, like XLRE and XHB, it just don't make a lot of sense to me with where rates are and where prices are. I think they're out of step, and I hope to be wrong. But again, I wouldn't trade on my opinion. I learned that the hard way a long time ago. But if I just drop this in, these don't have fibs on them because I'm not treating them as like major sectors. But if I drop a fib in, if I drop a support line in here, just a really quickly, crudely drawn support line right about there, maybe, you can see that this really lost it. This too is having a little bit of negative divergence. Really not negative divergence. I shouldn't say that. I should say really just technical weakening right on this lower high. It didn't really make a higher high. I thought it was a lot closer on the small look, but you can see this is clearly a high, much higher high than the other ones that registered here more recently. But that's, excuse me, showing weakening. Let's look at XLV. This has been resilient, right? So this is not good, in my opinion, that this thing's hanging out as well as it is. And the reason for that is it's a defensive. I look at it as a defensive sector. And this has been bid. And I missed a great trade through UOA and Merck, and I'm not happy about it. But it's very hard for me to catch them all with all the typing I've got to do and so on and so forth to get ideas out. But anyway, that's had a good week despite what's happened elsewhere. And again, I think that's concerning. So I would treat it that way. XLP, I'll look at another one that's, I think, excuse me, more concerning because I look at this as Staples as a little bit more defensive relative to XLY, which I do think I have a fib on because this was a great runner. And you can see, right, that this has gotten battered. And I think when you see that the discretionary names getting hit and the staples being bought and the pharmaceuticals and healthcare, that's telling you that the defensive rotation is largely in place. Now, right after this kind of ridiculous run that this thing had, it was flashing some weakening. You got the breakdown on this, and you can see, I wish I would have had a chance to get more of these names in here, but it actually returned really, in my mind, this is a good little reminder. If you see where we're back to now, it's right back to the breakout point. This is often a target in my mind. A lot of times you see this kind of round trip to where the breakout launched from. And the breakout launched from just about where we are, not too far away from where we were at the lows today. So that's a good example. Really kind of got cracked pretty hard. It is down to about 44, I think, on your RSI 45. So again, you really want to see this thing hold up near here and hold what could be converted to support, hold here, not get too deep of a pullback RSI wise or fib wise, and that'll show you that there's still strength there. If not, right, we know the next levels are right there at 38.2, and there's a flat line right near there pretty much. So call it 168.50 to 170, a little bit down from where we are your next ones in my book. Transport's another important sector. Got a fib on this one. Good sign today that it is hanging out. It's putting up a little bit better of a fight. The last 3 sessions, it's been hanging in there. You could see, if I look back in time, I see a flat line right away, right where it found support at, basically. So 80.21, we'll call it, just for a number. But trying to reverse, needs to get back above the 20-day and hold, right? You don't want to see just go up there and then end up failing because that'll mean, it just closed the gap. Couldn't get above the nearest, probably one of the more important shorter term SMAs, and it went right back into rollover. That would portend possible retest would be probably favored of the recent lows, maybe a whole nother leg of selling that takes it down towards the 50 and 200, 200 in purple, 50 in gold down here. That would also close this gap. So, and get you right near the 50% retracement. So remember, like if you're a bull, you want to see shallow retracements because you want there to still be strength and you just want to keep adding to that. But I think the market's going to be hard pressed to act that way myself easily. In the near term, after what we've seen, I hope to be dead wrong. XLB, there's no fib on this one, but you can see that use the 20-day in late blue to say, did it crack the trend? And it kind of did, right? So it's at risk of really cracking right now. That would invite more downside there. But quite frankly, it's hanging in there at a decent level. And that is a little bit of encouragement. The market is making slightly lower lows in the SPY and Qs today versus the lowest lows that they put in earlier today and on Thursday. Not all indices, major indices are doing that, but that's what's happening in the Qs and SPY ETFs. And that's a little bit of a good sign here with about 15 minutes to go, where they're trying to, I think, flush out people that basically, right, the nervous hands, as they always say, right, that they want to flush them out, maybe bring new shorts in who think we're going to have an awful weekend crater. And it could be a little bit of a hint that maybe they're going to try to put a little relief rally together over the weekend. News neutral assumption on that, of course. here's a great example of tried to get back to the 20 in XLI, couldn't do it, right? It got kind of got repelled, and it's right back to where it's been holding and hanging out. Slightly lower low, but this could be a higher close. Again, just a slight hint that maybe there's going to be a little attempt at something. So you can see where the fibs are. We're not even at the 23.6, certainly still far from the 38.2. If it did take another leap lower, you would probably expect the rising 50 to be right near that 107.42 should it get there. So that's what I would put out for that downside. I think upside, you could see the minimum you need is to at least get above the 20 to start feeling better about it. Until then, it's kind of in right bears in control for now, and we'll see what happens. XLU, I'll flash it, but not really worth talking about because we don't really trade that one. It's a little bit more of a defensive name, but and it did act pretty well this week. But remember, it's kind of inverse to rates. So the fact that it did, what I would add is the fact that rates moved up this week, the TNX moved up, and so did utilities. That's also, to me, showing a favoring of a defensive positioning right now. So just keep that in mind. Not that you would know by what the VIX has done. It's been a rough week for the market overall, and the VIX is again kind of sitting there with a little bit of a pouty face on a Friday. That's really not anything new, right? But you're look where you were earlier today. Look where you are now. This thing just is just not what it used to be, at least at this moment. So the VIX still struggling for respect. What else do I have? Oh yeah, let's go back to SMH since it's so important. And I'll cover some gold. We'll cover some other things, and we'll wrap things up here. I have to get on time for cocktail. SMH, right? Kind of a little bit of a hint of positivity. We already talked about it earlier. Is a little bit right overdone. You could see that some of the MACD readings got a little overdone. So this was a pretty swift sell-off. But you'll notice that the RSI, even at the lowest point on the close of yesterday, was at 45. And so, right, again, if we're going to get bull market-esque behavior, the way that people are claiming, we shouldn't really dip that far down. So we will see, right? That would sort of a little bit tiny little signs that something good could be happening. Let's take a look at GLD, and I'll take a look at the Mag 7, and we'll wrap things up. Remember, dollar rallying this week. Rates up, gold off, SLV. I'll look at quickly. It's I'd be shocked if it weren't the same or worse. It's worse, right? It's the same or worse. And that's what you'd expect, right, with the way that rates, I think, of the dollar have lifted. Let me take a look at CL real quick. I don't think it's going to tell us anything different than XLE. It's been a little more challenged than XLE. It seems like XLE tries to give us a good story, and then it fails, and it seems like crude's just not been buying that story that XLE wants to promulgate. That is looking a little bit better, so keep your eye on that. That would be a possible really good trader. I don't think it helps inflation, but it would be good for the health of the market and a good trader on its own if it can take out that 50. You can see that 50 right there in gold. That's basically, at this point, I think, the main thing to look out for. We switched over to percentages. I really don't like that. I'm not sure why it does that. Come on, Thinkorswim, killing me. Anyway, that's going to put you at around call it 76, just round it off to 76. So we need to do some work. I keep getting some ideas in there. I keep thinking they're really getting close, but maybe if the market gets back on the horse, CL will join the party. Maybe that's what we need, the sinking of those two. We have looked at wood and cut. I would expect that they're down given the news this week, given rates, given what XHB has done. They've come off. They did try to spike it back up. They both obviously probably both came off, and they did. Nothing really major to add there. They're just backing off naturally. Still out of touch with my spidey sense about people affording homes at these prices at these rates. But my spidey sense isn't worth anything anyway. That's why I use charts. There you go. So here's copper, and we were seeing some good signs out of that. back off, right? Again, because the globe is not really firing, right? That's part of the problem. So a lot of these things are just not firing enough. Let's take a look at the Mag 7 altogether. AAPL, AM. Oops, I have a typo there. It's not what you want after you type. Oh, it doesn't like my, okay, plus, no. Apple plus. Geez. Thinkorswim's lagging and it's just giving me fits, as you can see. AMZN, Meta. I did it again, but Microsoft, Google, which I should have put in for Meta, NVIDIA, and Tesla. And there's our names. Let's see how that's shaping up. That was, remember, we were saying, okay, keep your eye on it for the false breakout. Well, that again, that's another false breakout. And that's, it was good that we covered those last week. I mean, I try to keep an eye on them, of course, but I don't always get to them in terms of the video. But I think that the individual vulnerabilities that we saw helps. I've got to try to, maybe some folks will remind me to do that every week, where it's worth looking at these things every week, because we went through there and some were kind of more neutral, but on balance, I felt like there just looked like there was vulnerability. There was definitely vulnerability in Apple. I'm pretty sure we talked about that. Let's see, Amazon. I thought Amazon looked better than other things, but clearly, right, it didn't matter. It was hanging in there a little bit better, but obviously it's had a rough week this week, right? So nothing we can really, right? This was just the package overall looking challenged. And we were a little cautious and kind of sensing that there were some fissures appearing there, and they really did develop. I mean, that they developed into real cracks in these some of these charts and these big names. I'm going to wrap up after we get this done, though. I've got to try to make sure I've got a little bit of water and stuff like that for cocktail hour. Come on. Come on, there's Google, and it too backed off, right? This one's been a little disappointing. I've had a lot of UOA. I've tried to get in there thinking it's really going to fire at some point, but um, overall, I mean, kind of leading up in that it's kind of was consolidating, just hasn't delivered a lot. Meta, it's recovered better than other ones already, right? So that's, if they do get these things going again, that'll be right above the 10-day. That'll put it above all of them. It's got a higher high, higher low look that's just still working. The 20 held like a champ there in light blue. So if they do start to push back up, I think one you got to keep your eye on right now is Meta. I mean, that to me, I hate to say that because I really don't care for the 1984-ish impulses of the leader of that company, but what can you do? That's the world we're in these days. Let's see here. Yeah, I'm coming to a crawl here, so I better wrap this up. Let's just get through a few more stocks. Thinkorswim's really slowing down on me. That's what I meant by Microsoft being neutral. Like right now, right? Here's what I would tell anybody. If the market's looking heavy, rates are going up, dollar going up, Microsoft breaks below Thursday's low, I'm a seller. On the flip side, right, everything reversed. I'll buy it above the 10-day right there. I mean, it's very tightly wound. So if you can get volatility cheap in there, that might be one to keep an eye on. Usually vol will get crushed when a stock flatlines, as long as that has. Market makers are puking on playing the long side, and you could take some cheap vol off their hands at an opportune time if you're sensing a breakout. That would be nice. Nice recovery to this point, right? Rough start, but nice recovery by the flagship. So that's looking better. Remember, you kind of got an ascending triangle going there. So higher lows. So just need to make higher highs, and maybe that rights the ship since everyone's got their wagons hitched here. So some of these nascent signs, there's a couple little good things happening, right? Don't want to read too much into them. You got to wait till Monday, but there's a little bit happening here that we could say, well, this is not a complete disaster. It's not still not a good looking week, right? But there's a couple little hints that maybe it's going to get better. So excuse me for 1 second. I'll be with you in 1 second. So on that note, I better wrap it up. I want to thank everyone for tuning in. I want to wish everyone a wonderful weekend and get your game face on for next week, because I think we're going to be in for more fun like we were in this week. It just might be in both directions rather than one. So everyone take care, and thanks again for tuning in.